Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his Monday guest, Mr. Greg Dickerson. How you doing, sir?
Doing great, Michael. Good to see you.
Thank you for coming back every week. Again, your call in video number 2 about the great deleverage. I don't know when that was, 2-3 months ago, is a call of all time. So great work on that.
Yeah, thank you. Yeah, we'll see how far and how fast. And then the next call will be the great inflation again.
Yeah, exactly.
The great reinflation.
Yeah, reinflation. There you go. Well, hey, one of the things that's been a topic in my private Facebook group called One Rental at a Time Works recently is, as an investor, as an entrepreneur, when you are looking to add assets, what is most important? Cash flow or appreciation or equity buildup or whatever you want to call that? When you evaluate stuff, when you were building, what were you looking for? What was important to you?
So it depends on what it is. So if it's a business, if it's a company, so my background is, I bought and built companies and exited them. And then I bought and built real estate and exited that. So I had a business that generated cash flow that I could invest into other assets. So first and foremost, cash flow is important. You got to meet your bills. You got to be able to, pay your bills, and you got to be able to live so that the pressure's off. So then you can do what you want to do and you can be creative and take advantage of opportunities. But when you're evaluating businesses, it's all about, now for me, and even back then, it's all about scale, right? So you're looking for something that you can scale. And, the ways that you scale that are by leveraging, the people, leveraging the assets, or leveraging the cash flow. And, in this day and age, the highest multiples are reoccurring revenue business models. So, that's where you're getting the highest multiples now, and or the network effect. So if you have a big network like Facebook, Instagram, things like that, they're not making any money. There's not a whole lot of revenue initially, but they have a big user base, so that's scalable and that's valuable. So, from a general standpoint of buying and building a company, it's all about your cash flow. It's all about your EBITDA, and it's going to trade on a multiple of that. Although in the last couple of years, that kind of got skewed toward revenues and user base.
Revenue. Yeah. I was like, whoa, where did that come from? I've been here before.
Right. So it hadn't necessarily been about cash flow, but for me, I like to see, a business model that is sustainable, because, I'm just not somebody that can go out and take a SPAC to Wall Street and just get stupid money,
Yeah. So let me try to summarize what I think I heard you say. So basically, if you're looking to evaluate a business or whatnot, you're looking for a business that's profitable, i.e. has positive cash flow. And then your job, your gift, your abilities, you're trying to leverage that up. Maybe you can buy the asset at 3x and you want to ladder it up with systems, processes, people to 30x. I'm just throwing out
exactly numbers. And or add, complementary pieces onto it, bundle up the same types of businesses that are just in different locations, or add complementary businesses, which is what I did. Along the way, I scaled up by adding complementary businesses to my main companies and then exited those. Now, if we're talking about real estate, it all depends on what you're doing. If you're flipping houses or building and selling or whatever, you're looking for appreciation, right? It's all speculative. So from a speculative standpoint, I'm looking for appreciation. From a growth standpoint, I'm looking for cash flow and scale. So if I'm buying a commercial asset that's existing, whether it's multifamily, commercial, whatever, I'm looking for cash flow, long-term cash flow. And, I want some appreciation as well, but I really don't care that much about appreciation if I have enough cash flow, if that's the type of asset I'm buying. So you can pay whatever you want for an income producing property as long as it cash flows. And as long as you have long-term debt, so that your principal is going to get paid down, you're going to have positive cash flow. You don't really need appreciation. It's good, but you don't need it, and that's kind of the market we're in now with cap rates and things like that. You're buying cash flow.
Yeah. And again, I want to remind folks, I think we talked about a video again, when you were doing, I don't know, I'll call them large, it might even be gigantic beachfront homes right before the last recession and got, right? You were building, I would call it speculation. I don't know if you would call it that, but you were building into that. The market turned and that was an out.
Yeah. And what's good about, so I was speculating on appreciation, but what was good about that and the types of properties that I always did, before and after that was that I had cash flow to sustain them.
Right.
If the values, went down or I couldn't sell and make extra money, I still had the cash flow. So obviously you want to have cash flow and appreciation if you can get it. But yeah, what happened there, that was 2008 and 9. I had a bunch of, multi-million-dollar beach houses I was building. I had great cash flow. They were all coming, $200,000 a year in cash flow. So they would service the debt and cover the expenses, but all of the value got wiped out because of what happened in 08, 09. So I'd finished building these houses. And I had $30, $40 million worth of them, something like that. And, Lehman Brothers was my lender, that was going to take out the construction loans into
Right.
permanent mortgages. And when I finished and went to get the permanent mortgages, Lehman Brothers was no longer.
Yeah, Lehman, where'd they go?
They were gone.
They left
and I
the
didn't
building.
know what was going on. I had no clue about all of this,
Yeah.
back then. And really, the really interesting thing about all that, what a lot of people didn't grasp is, if you think about that whole system, the instruments that were created by these companies that were sold to Wall Street that became toxic assets, the derivatives that ended up tanking the financial system, were all created and rated by the same people that sold them. So that when everything went down and the government came in and bailed them out, the people that created and rated and sold these and made, billions of dollars, okay, they got bailed out by the federal government, okay, and made whole.
Yeah.
And then the government took over all these toxic assets, these bad loans. Then they came back in and bought them back for pennies on the dollar.
Yeah.
So you wonder how much of that was really from the beginning, a little bit of insider, information going, hey, we can kind of do this. Not that the government knew, but the Wall Street, investment banks kind of knew, just like they know now, Powell's going to jump in whenever there's a hiccup so they can go do some bad things. So they kind of knew, hey, we're going to get bailed out. We'll be able to create these things, sell them. They're going to go bust. We'll get made whole. Then we can buy them back and do it all over again.
Wow. So that's funny. I have people in my network that actually think that was the plan, right? Let's blow up a bubble so big that the only option is they bail us out. Then we'll have that money to go buy them back for nothing. Wow.
So that's not a conspiracy theory. That's just business. That's just business.
It's crazy.
And just like in the world of investment banking and equity capital, there are, companies that will buy businesses, exit them so they can buy it back later for pennies on the dollar because they sold it for too much.
Yep. They're over
somebody
leveraged.
else.
Yep.
It's not going to work. So you buy it back and you do it again.
Yeah, no, it's happened lots of times. That is frightening to think about. I still want to believe that Wall Street was just stupid. I want to say they were stupid and greedy. But maybe not.
Well,
maybe.
Not stupid, greedy.
Greedy, yes.
Definitely
greedy.
And, what are you going to do? This was it was all created by the government, right? It was all interest rate policy, Fed policy. That's where it all came from. And it was Greenspan.
Home ownership.
Single-handedly tanked, the real estate market, with his interest rate policy and
too low, too long.
Yeah. And money supply.
Yeah. Crazy. This is fun to think about. So again, I guess what I'm hearing you say is cash flow is your lifeline. You need that or bad things happen. You can take cash flow, add on more parts, create a higher multiple, and really build wealth with appreciation. But I think for you, it starts with cash flow. You got to buy a business cash flow so you can survive. But the real wealth is made with appreciation. Might that be a decent summary?
Yeah. So, okay. Wealth. All right. So, being rich is having money.
Correct.
Wealth is not needing money. Okay.
Ooh,
so if you're wealthy, you don't need appreciation. Okay. If you're wealthy, you've got cash flow, you've got assets, you don't necessarily need appreciation. If you're rich, you might have, a little bit of cash flow, but you need that appreciation because that's ultimately where you're going. So, it just depends on what it is. If you're speculating, you need appreciation. Stocks, cryptos, real estate, companies, right? I'm going to buy, add value, sell. You need appreciation if that's how the business model works. If there's a component of cash flow and your goal is to grow the cash flow because that's what creates the value, the value doesn't really matter because you got the cash flow, right? So if you're buying an income producing asset, it's all about the cash flow. Appreciation is great. That's a bonus, but like you said, don't buy an alligator, right?
Yeah. No alligators. Yeah. Absolutely.
So that's kind of how I look at it.
Yeah. Say that one more time. Rich. I love that. I've never heard that phrase before. Wealthy don't need money. Rich need, what was it again?
Yeah. Rich have money. The wealthy don't need it.
Rich. I'm going to write that down. I'm going to have to sit on that for a little bit because that feels like there's like wisdom and gold in that statement.
Well, and you got to understand money is time, money is energy. Yes. Okay. So if you're rich, you have money, but you have to spend time and energy to keep accumulating. If you're wealthy, you don't need it because you have all of the time and all of your energy that you can spend elsewhere because you've already got it. Right. So, that's just that level where you talk about, you and I have talked about rich versus wealthy.
Yeah. Yeah. Very cool.
Wealth is all of the time and all the energy you need to do whatever you want, whenever you want, wherever you want. You don't have to worry about it.
That's awesome. I want to be wealthy, not rich. That's my goal. That's awesome. So Greg, how can people find you? This has been such a fun conversation.
Yeah, gregdickerson.com. That's where all my social media, YouTube, podcast, all that lives. gregdickerson.com.
Very cool. Thanks, buddy.